September 15, 2008, 1:47 a.m., Midtown Manhattan. The conference room on the 13th floor held 37 people and no answers. Through the windows, the city still glittered, oblivious, magnificent, doomed. Inside, under fluorescent wash, men in shirt sleeves studied spreadsheets that no longer made sense. The numbers had stopped behaving. Lehman Brothers, 158 years old, had 6 hours of liquidity remaining. A phone rang. No one moved to answer it. Outside, on the trading floors below, young analysts were boxing their desk plants, their framed diplomas, their lucky ties. Some wept quietly. Others refreshed their bank balances on desktop screens, watching zeros flicker like dying stars. By dawn, 25,000 employees would be unemployed. By October, $10 trillion in market value would evaporate worldwide. But in that stillness, that terrible, suspended moment between solvency and ruin, the only sound was paper rustling and the hum of ventilation systems designed to keep everything cool. They had believed the system was unbreakable. They had not considered who might profit from breaking it. 3 blocks south, in a nondescript office building that housed a hedge fund most Americans had never heard of, a different kind of evening was unfolding. Here, champagne had been ordered. Not ostentatiously, these were careful men, methodical men, men who understood that celebrating while the world burned was poor optics. But they permitted themselves a quiet acknowledgement. The trades they had placed 18 months earlier, positions that had been mocked as lunacy by every major bank on Wall Street, were about to pay out sums so vast they bordered on obscene. They had seen it coming. Not prophetically, not through luck, through arithmetic, through reading documents that everyone else had access to but no one else had bothered to study, through asking one question that Wall Street, drunk on fees and bonuses and the narcotic of perpetual growth, had forgotten to ask. What happens when people can't pay? The answer was arriving now, in real time, transmitted through fiber optic cables at the speed of light. Collapse. Contagion. Catastrophe. And for a select few who had bet against the American dream itself, unimaginable wealth. To understand how this was possible, how a handful of investors turned apocalypse into profit while titans of finance drowned in their own hubris, you must go back. Not to 2008, but to the architecture of greed that made that year inevitable. You must go back to 1999, when a law was repealed. To 2004, when a rule was changed. To every moment when warning signs were visible but inconvenient, when regulators had power but no will, when the machinery of American finance was quietly reconfigured to reward recklessness and punish caution. This is not the story you've been told about the financial crisis. This is the story of the ones who understood the con and made fortunes exposing it. The boom. In the beginning, there was a house. Not metaphorically, literally. A ranch-style, 3-bedroom house in Bakersfield, California, purchased in 2005 by a strawberry picker named Jesus Huerta for $724,000. Jesus made $14,000 a year. He spoke limited English. The mortgage broker who facilitated his loan filled out the paperwork herself, inflating his stated income to $100,000 without his knowledge. No verification required. No documentation needed. The loan was approved in 48 hours. This was called a ninja loan. No income, no job, no assets. Wall Street loved them. Within days, Jesus's mortgage was bundled with thousands of others. Teachers in Florida buying investment properties, retirees in Arizona taking cash-out refinances, cab drivers in Las Vegas speculating on condos, and sold to investment banks in New York. There, financial engineers sliced the bundle into tranches, assigned them credit ratings, and sold them to pension funds in Norway, insurance companies in Germany, sovereign wealth funds in Abu Dhabi. The strawberry picker's unpayable debt had become a AAA-rated security, as safe as treasury bonds. On paper. By 2006, American homeownership had become a roulette wheel spinning faster than physics allowed. Housing prices climbed 15% annually. Mortgage origination hit $3 trillion, triple the historical average. Banks weren't lending money anymore, they were manufacturing product. The product was debt, packaged and repackaged, layered with derivatives and synthetic instruments so complex that the traders selling them couldn't explain their risk profiles. On trading floors from Greenwich to London, 26-year-olds with Ivy League degrees earned seven-figure bonuses structuring securities backed by loans given to people who would never make a single payment. The fee structure was perverse. Originators were paid up front, then sold the risk downstream. By the time default arrived, the loan officer had his commission, the bank had its fee, and the pension fund in Oslo was holding the bag. But in 2006, no one was defaulting. Housing prices only went up. They had always gone up. They would always go up. Everyone knew this. Except for the few who read the paperwork. If you're already questioning everything you thought you knew about 2008, hit subscribe, because the people who profited from this saw details no one else would look at. The heretics. His name was Michael Burry, and Wall Street thought he was insane. A medical doctor turned hedge fund manager, Burry ran Scion Capital from a small office in San Jose, working alone, often barefoot, communicating with investors primarily through email. He had Asperger's syndrome and a glass eye, legacies of childhood retinoblastoma, and he possessed the rarest trait in American finance. He read prospectuses. In early 2005, while researching mortgage-backed securities, Burry began downloading loan-level data from bond offerings. Not summaries. Not ratings agency reports. The actual borrower information buried in 130-page documents that institutional investors paid interns to skim. What he found was horrifying. Loan-to-value ratios of 100%. Interest-only payments with balloon clauses. Adjustable-rate mortgages scheduled to reset in 2007, doubling monthly payments for borrowers who could barely afford the teaser rates. These weren't mortgages, they were financial time bombs, and they were being rated AAA by Moody's and Standard & Poor's. Burry called Goldman Sachs. He called Deutsche Bank. He asked a question no one on Wall Street had considered. Can I short a mortgage bond? The bankers laughed. Mortgage bonds didn't default. Housing was stable. What Burry was proposing, buying insurance against the collapse of American real estate, was like insuring against the sun rising. But Burry was offering to pay premiums. And Wall Street never turns down a fee. By the end of 2005, Burry had purchased over $1 billion in credit default swaps, essentially insurance policies that would pay out if mortgage bonds failed. His investors were furious. His wife questioned his sanity. Goldman Sachs traders joked about him in emails later made public. The market can stay irrational longer than you can stay solvent. They were half right. The market was irrational. But Burry had done the math. And the math was unforgiving. He wasn't alone. In New York, a small hedge fund manager named Steve Eisman, cynical, profane, righteously angry, was arriving at the same conclusion through a different route. Eisman had spent years analyzing subprime lenders, watching them prey on working-class families with deceptive teaser rates and prepayment penalties. He'd seen the predatory machinery up close. In 2006, Eisman attended a conference in Las Vegas where mortgage originators bragged about loan volumes, where rating agencies explained their models, where Wall Street celebrated the greatest money-printing machine in history. He listened to a presentation from a company that specialized in second mortgages, loans given to people who'd already borrowed 100% of their home's value. How is that possible? Eisman asked. What's the collateral? The presenter smiled. The home will appreciate. Eisman left the conference nauseated. He began shorting everything: mortgage originators, banks holding mortgage exposure, insurance companies guaranteeing mortgage debt. His team called it the Big Short. They expected to get rich. But first, they expected to watch the financial system immolate itself. Meanwhile, in California, two young traders named Charlie Ledley and Jamie Mai were making the same bet from their garage-based hedge fund with $110,000 in capital. They'd been studying tail risk, the statistical probability of catastrophic events that models assumed were impossible. Housing collapse was supposed to be a 10,000-year flood. But when Ledley actually read the mortgage documents, he realized it wasn't a flood. It was an inevitability. They, too, bought credit default swaps. Billions of dollars in insurance, purchased for pennies on the dollar. And then they waited. The whisper before the scream. The first crack appeared in February 2007. HSBC announced losses in its U.S. mortgage division. Small losses, contained, manageable. The stock dipped 1.4% and recovered by Thursday. In April, New Century Financial, the second-largest subprime lender in America, filed for bankruptcy. Again, the market shrugged. Subprime was only 12% of the mortgage market. The damage would be contained. By June, two Bear Stearns hedge funds holding $20 billion in mortgage-backed securities had collapsed. Bear Stearns injected $3.2 billion to prevent complete liquidation. On CNBC, Jim Cramer screamed into the camera, "They know nothing," referring to the Federal Reserve's indifference to the brewing disaster. But the Fed did nothing. Treasury Secretary Henry Paulson, former CEO of Goldman Sachs, assured Congress that subprime losses were largely contained. Ben Bernanke, chairman of the Federal Reserve, testified that housing troubles would not spill into the broader economy. Michael Burry, watching his positions lose money every day as premiums piled up and bonds refused to default, was vindicated and ruined simultaneously. His investors demanded their money back. Some sued. He was paying millions monthly to maintain insurance on assets that hadn't failed yet. The system had one more year of denial left. Jesus Huerta made his last mortgage payment in August 2007. The adjustable rate had reset. His monthly payment had jumped from $2,400 to $4,200. He earned $1,100 a month. The arithmetic was simple and unsolvable. He called the bank. They offered him a modification, a new loan with a higher principal and longer term. He would owe more forever. He declined. In November, he received a foreclosure notice. By January 2008, the house was empty. Across America, the same scene was replicating. Not by the dozens, by the thousands. Foreclosure filings doubled. Housing inventory surged. Prices began to fall. And once prices began falling, the entire architecture collapsed. Because the mortgage bonds weren't just risky, they were fraudulent. Ratings agencies had given AAA ratings to securities they knew were toxic because issuers paid for the ratings. Banks had sold bonds they simultaneously bet against, hiding risk in off-balance sheet vehicles. Insurance companies like AIG had guaranteed trillions in mortgage debt without capital reserves to cover losses. Everyone had assumed the music would never stop. But in early 2008, the DJ left the building. The unraveling. March 14, 2008. Bear Stearns, 85 years old, America's fifth-largest investment bank, had 72 hours of liquidity remaining. Clients were pulling funds. Counterparties were refusing trades. The Federal Reserve arranged an emergency sale to JP Morgan Chase for $2 per share, a company valued at $170 per share 6 months earlier. On trading floors across Manhattan, a new terror took hold. Bear could fail, anyone could fail. Michael Burry's credit default swaps, purchased for millions, were now worth billions. He was proven right, but he took no victory lap. In an email to his investors, he wrote, "I never thought I'd see the financial system come this close to the edge. I'm relieved to have been correct, but horrified by what that correctness means." Steve Eisman, watching banks disintegrate in real time, felt no satisfaction. He'd bet against a corrupt system, but he hadn't wanted to watch millions lose their homes, their jobs, their futures. In a later interview, he said, "We weren't rooting for this. We just saw that it was inevitable. That's different. If this is changing how you see the financial system, and the few who profited from its collapse, subscribe now. The climax will reveal exactly how broken the system truly was." Summer 2008 was the long, slow burn before the explosion. Fannie Mae and Freddie Mac, the government-sponsored entities backing half of America's mortgages, were insolvent. The federal government placed them in conservatorship in early September, seizing control and injecting $200 billion in taxpayer funds. Wall Street barely noticed. Fannie and Freddie were expected to be bailed out. They were too embedded, too essential, too politically connected to fail. But Lehman Brothers was different. Lehman was pure investment banking. No depositors, no consumer arm, no political leverage. Treasury Secretary Paulson decided to let the market work. No bailout. No rescue. On September 12, Lehman CEO Richard Fuld called every major bank seeking a merger. No one answered. On September 15, at 1:45 a.m., Lehman Brothers filed for Chapter 11 bankruptcy, the largest bankruptcy in American history. $639 billion in assets vaporized. The next morning, the world woke to a new reality. Merrill Lynch sold to Bank of America in a desperate weekend negotiation. AIG, the world's largest insurer, nationalized after $180 billion in bailout funds. Washington Mutual, seized by regulators, the largest bank failure in U.S. history. Wachovia, sold to Wells Fargo to prevent collapse. Money market funds, considered safer than savings accounts, broke the buck, losing value. Commercial paper markets froze. Credit disappeared. Companies couldn't make payroll. The global financial system, built on the assumption that institutions would always honor their debts, stopped functioning. On October 10, 2008, the Dow Jones Industrial Average fell 697 points. Retirement accounts evaporated. Unemployment lines stretched for blocks. The crisis, born in the American housing market, had become pandemic. And through it all, the ones who'd seen it coming, Burry, Eisman, Ledley, Mai, and others whose names would never be public, watched their positions pay out. Scion Capital made a 489% return for its investors. Front Point Partners, where Eisman worked, made over $1 billion. Cornwall Capital, run by Ledley and Mai, turned $110,000 into $80 million. They had been right. And they had profited obscenely from being right. But the profit was cold comfort. The system explained. How had this been allowed? How had the largest economy on earth constructed a doomsday machine and handed the keys to mortgage brokers in strip malls? The answer was not conspiracy. It was incentive. Start in 1999, when the Glass-Steagall Act, Depression-era legislation separating commercial and investment banking, was repealed. The walls came down. Banks that held deposits could now gamble with them. Risk and safety merged. In 2004, the SEC changed a rule governing net capital requirements for broker-dealers. 5 firms, Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman Brothers, and Bear Stearns, were allowed to increase their leverage from 12 to 1 to as high as 40 to 1. For every dollar they held, they could borrow 40. When markets rose, profits were extraordinary. When markets fell, annihilation was instant. Rating agencies were paid by the institutions whose securities they rated. If Moody's gave a harsh rating, Goldman took its business to Standard & Poor's. So ratings inflated. AAA became meaningless. Regulators, ideologically committed to free markets and philosophically opposed to intervention, declined to investigate. Brooks Laybourne, head of the Commodity Futures Trading Commission, tried to regulate derivatives in 1998. She was silenced by Alan Greenspan, Larry Summers, and Robert Rubin. The market, they insisted, would self-correct. The market corrected. It corrected 9 million people out of their homes. It corrected $16 trillion in household wealth into nothingness. It corrected the global economy into the worst recession since the Great Depression. Deregulation. Leverage. 3 words. 1 disaster. The testimony. On January 13, 2010, the Financial Crisis Inquiry Commission held its first public hearing. Lloyd Blankfein, CEO of Goldman Sachs, sat before Congress and explained that his firm had shorted the same mortgage bonds it sold to clients, a maneuver so baldly predatory that even senators who barely understood finance recoiled. "Your clients trusted you," Commissioner Phil Angelide said. Blankfein, unruffled, replied, "Our clients are sophisticated investors." Michael Burry testified later, less publicly. He was asked whether he felt responsible for profiting from disaster. His answer, delivered flatly without performance: "I saw what was true. I acted on it. The crisis wasn't caused by people like me noticing the fraud. It was caused by the fraud itself." Years later, Steve Eisman would give a speech at a banking conference. He opened with one line: "I want to be clear, we didn't cause this. We just read the documents." The consequences rolled out slowly, then all at once. The Troubled Asset Relief Program, $700 billion in taxpayer funds to stabilize banks. The American Recovery and Reinvestment Act, $800 billion in stimulus. The Federal Reserve's balance sheet ballooned from $900 billion to $4.5 trillion as it purchased toxic assets to keep markets liquid. Unemployment peaked at 10%. Foreclosures reached 2.9 million in 2010 alone. The crisis destroyed $16 trillion in household net worth. An entire generation lost faith in homeownership, in markets, in institutions. The banks that caused the collapse were bailed out. Not a single senior executive at a major Wall Street firm faced criminal prosecution. Fines were levied, billions in settlements paid by shareholders, not individuals. The system was preserved, but trust was not. The aftermath. By 2012, markets had stabilized. Dodd-Frank financial reform passed, a 2,300-page behemoth aimed at preventing another collapse. Volcker rule prohibited proprietary trading by banks. Stress tests measured systemic risk. The Consumer Financial Protection Bureau was established to regulate predatory lending. It was something. It wasn't enough. Because the fundamental structure remained unchanged: privatized profit, socialized risk. Banks grew larger post-crisis. Too big to fail, became even bigger. Derivatives markets remained opaque. Credit default swaps, the instruments that had both exposed the crisis and enriched the few who understood it, were lightly regulated but not banned. Michael Burry closed Scion Capital in 2008, exhausted by the fight with his investors and sickened by the devastation. He later wrote in a New York Times op-ed, "I was right, but I didn't enjoy being right. I wanted to be wrong." Steve Eisman continued managing money, but with a new philosophy: bet on things that help people, not on collapse. He became an advocate for financial reform. Charlie Ledley and Jamie Mai walked away from finance entirely, retreating to small-scale investing and philanthropy. The wealth they'd accumulated felt, in Ledley's words, like blood money. Jesus Huerta never bought another home. He moved into a rental, saved what he could, sent money to family in Mexico. When asked years later what he remembered about the foreclosure, he said simply, "I thought if you signed the papers, you were safe. I didn't know they could lie." Across America, 9 million families learned the same lesson. The papers could lie. The ratings could lie. The system could lie. And the ones who told the truth, the ones who read the documents and saw the con, became wealthy beyond measure for understanding what should never have been allowed to happen. If you're seeing the financial world differently now, if you're realizing how deeply the game was rigged, subscribe. Because history is full of moments like this, and understanding them changes everything. The circle closes. September 15, 2018. 10 years after Lehman collapsed. On Wall Street, a memorial plaque was unveiled outside the old headquarters, now owned by Barclays. The inscription was brief, bureaucratic, historical. Inside a conference room 3 blocks south, the same building where champagne had been poured in 2008, a different kind of gathering was taking place. Former traders, now graying, meeting quietly to discuss what they'd learned. One of them, who'd made $200 million shorting subprime, spoke last. "We weren't smarter," he said. "We just read what was public. The fraud was there for anyone to see. But no one wanted to see it, because seeing it meant questioning everything." He paused. The system didn't fail. The system worked exactly as it was designed, to enrich insiders and insulate them from consequences. We didn't break it. We just noticed it was already broken. The light in that conference room was the same as it had been a decade earlier: fluorescent, sterile, cold. Outside, the city glittered as it always had. Markets had recovered. Indexes had reached record highs. New towers were rising where old ones had stood. But something essential had changed. Trust, once given freely, now came with questions. The myth of the self-correcting market had died with Lehman Brothers. And in its place, a harder truth. Systems require vigilance. Markets require regulation. Trust requires accountability. The few who saw the crisis coming didn't cause it. They simply recognized what everyone else refused to see, that the emperor had no clothes, the ratings had no meaning, and the American dream had been sliced into tranches and sold to the highest bidder. They got rich telling the truth. The rest of us paid for ignoring it. The bank doors are open again now. The loans are flowing. Housing prices are climbing. And somewhere, in an office you'll never see, someone is reading the documents everyone else ignores, asking the question no one wants answered. What happens when people can't pay? The answer is always the same. It's only the timing that changes. They had trusted the system, and learned that systems are built by men.